Hello, 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 everyone. How is everyone doing this fine Monday afternoon? Patrick, welcome. Patrick, the regular, many times the first one in. Good evening, Sashi. Hey, Stafford, how are you doing? Good afternoon. Good evening, Anissa, all the way from overseas. Jacob, good afternoon. Hey, George. The swing traders who switched to short. There were some interesting little moves down today. Interesting session. Uh yeah. So where do we sit now? By the way, if you are new here, please do consider subscribing, ringing the bell, and hitting the like the mic button. I hope everybody gets to check me out on the Jim Iorio Futures Edge podcast, posted today on the YouTube channel and on Spotify. So, all right, the S&P Composite PMI and Services PMI. Services coming in a tenth better. Composite coming in a tenth better, down from previous. That was not a surprise. ISM, though, coming in very, very strong. That was a surprise. That was a surprise. So does the Fed have to go still longer? I mean, it sort of I don't see us changing that 50 basis point. They've been too busy hammering that unless something really strange happens. But does that mean they go 50 in Feb? We shall find out. Remember, next Wednesday. What else do we have? We had employment ticking back up over 50. I said keep an eye on that. So employment bouncing back up. Prices, a little contraction from previous, but holding still high. So prices have sort of leveled out now at a higher range. Pretty red today. I'd say pretty red. Immediate Apple still holding up pretty well at only 80 basis points down. Microsoft getting a little more hammered. Tesla getting a little wrecked today. Oil reversal, triggering that little mini double top. So pull back there, and you got all those. But I mean, it sort of looks worse than it is. There was a lot of selling across the board. I mean, we had a decent pullback. No technical levels were breached. And you see some of the mega caps like Google and Apple held up a little better. So going to be interesting, but from a sector perspective, there was nowhere to hide. Everything. Utilities best performing, only down 86 basis points. Energy worst performing, down 269 basis points. Fed watch tool, 80% still favoring that 50 basis points. This did not really climb. So I think the market's pretty much accepted. Now it's really going to be tuning into. Remember, there is not one in January. The next major one is Feb. So that's where right now, if you look, this would take it to 4.25 to 4.5, but for Feb 1st, it would just be 4.75 to 5. So that's still favoring a 50 basis point potentially again in Feb. So, did I do that right? 4.25 to 4.5. So bottom bounce 4.25. Let me just double check. Yeah, that would be the quarter basis point. That would be the 50 basis point. So this looks like it's heading up. So 50-50. 50 in December, 50 potentially in Feb. So that's where it's coming out now. It's not really changing December that much. Now remember, we do have PPI and CPI. We have the Fed meeting, and then we have a massive, I think that should state how massive it is, quarterly OpEx next, not this Friday, but next Friday. So we're in for a doozy of some time, still in greed level. All right, as I talked about, no, I didn't even bother looking at GitLab if somebody wants to post it in here. There's nothing this afternoon, but tomorrow morning I am keeping a close eye on AutoZone. AutoZone is key. And no, for anybody wondering, I do not shop at J. Jill. I do not shop there. Just in case you were wondering where I do my clothes shopping. My deluxe wardrobe with the winter sweat jacket on. All right. Where do we sit? Let's see now who's in. Good evening, Charles. George, you can't give... You don't know. Christmas rally is traditionally around Christmas, and especially the last week between Christmas and New Year's. We got a lot to go, and this has not broken any technical levels yet. Yes, and this I can't even call the rug pull yet. This so far is an orderly pullback. Orderly pullback. We've not broken any technical levels. Also, interestingly enough, still watching where the day closes from this key CPI area lows, right about 404.50. But the major one from the last little swing, from the lows on the 17th of Thursday to the highs of December 1st. Look at that, tagging the 62.5. What was that? 62.5. 39.86.50. The low 39.87.25. So tagging that area and going to close above that. So I am still watching this, especially to confirm that would be for a retest of these lows that were put in, the Friday the 18th. Not even these. It could go a little below these lows. What really starts breaking, starts technical damage. Now this, if we get down here and really wipe out Powell Wednesday, J. Powell Wednesday, then that will trap all these buyers in, okay? Now the later day buyers are already trapped. The early day buyers aren't trapped yet. So, but then, even with a stop level, there'll be a lot of stops below this key area. Why? Not just because it's a key low. That's the more minor reason. More so, it's a breakout level combined with a key low, combined with a key moving average. That tests out 4 targets, i.e. support and resistance targets, pretty well. Not for long-term holding, but for short-term. So, and we have the technical channel, depending on how long it takes to get down here. So this is the level that really starts technical damage. Why you break down below here, you're going to get bailing, because then that traps everyone from end of day CPI Thursday or anybody who's bought since CPI Thursday. Your warning sign is if we get, this is where you use, and I'll take a look at comments again in a second, but this is what people overlook, the basics. The basics. Let me hide everything. Why should I bother using this silly little line chart? Because it can give you some valuable information. You can also see it on the candlestick, but sometimes it's very easy to look at this. So, on a closing basis, here was the close from CPI Thursday. Here was the close before Powell Wednesday, J. Powell Wednesday. Here was the low close after CPI Thursday, just below that CPI Thursday. Imagine what happens if you get a close. This is a key closing level I'm watching. What's that key closing level? Well, 39.55.25. Why? That's the early warning sign before that peak area that I talked about, the prior resistance becoming support and the breakout area from CPI Thursday. This is your warning sign. Everybody then would be trapped who bought after CPI Thursday or bought the close of CPI Thursday. CPI Thursday. So that starts the technical damage, and then this amplifies the technical damage. So far, what is this? Now, yes, I'm on alert But today was bloody, down 171 basis points in the S&P. But so far, look, this is just white. This just is closing below Friday's lows. No close below the rotation zone. No key close below that Thursday the 17th. We still have some more stuff to wipe out before it starts getting technically more ready for a breakdown. Also, remember, this is another thing that gets interesting. Tomorrow, there's very little going on. Nada. Zippo. And we're in Fed quiet speak. Fed no speaky speak quiet period. So we can't get blindsided by Fed. Now you can always get a article from Timoros, but he dropped something today pretty much, again, confirming that 50 basis point for December. And then it might go, they might be going for that terminal rate of 5% next year, early next year. That's the only thing that could really be the Fed leaky leak. We'll call it the Fed leaky leak. So I'll be on alert for that, but there's no guarantees with that. And then, what do we have? This gets interesting. Wednesday, there's nada. This is minor. Thursday, you got your ongoing jobless claims. Unless there's something substantial with this, I mean, these have been climbing, the continuing jobless claims. Don't get me wrong, and they passed our key level back a couple months ago, I think in September. Here's your next big thing. PPI, consumer sentiment. And then we have CPI next week. So we've got a Tuesday, Wednesday, Thursday of very little data on the schedule. Back to earnings. Thursday afternoon is the most critical earnings time. Everything else, you'll have, it'll affect these companies, but there's not a group of earnings that are as substantial as Thursday with Costco, Lululemon, DocuSign, Broadcom. Even though we're winding down earnings season, this is the big time. This is it. So Thursday afternoon, Friday is what you're looking for. Hey, Nas Industries, thank you. Oh, you remember the Tesla definitely on track to be worth more than Apple and Saudi Aramco combined? Hey, Dave. Are we finally ready to roll over to the downside? Well, I gave you my thoughts. Now, the NASDAQ, the technical level, this was JPOW Wednesday. Here was CPI. So, you know, the low closes I did on the S&P analysis would be from the Tuesday to 29th, actually. All right. So, if you bought, after, if the lowest close you could have bought was the 29th, if you didn't buy on the CPI, there were a couple other low closes, but that's the low key close. But right beyond that, this 11,465 is the breakdown, and that's a pretty decent probability. Right now, NASDAQ looks like inside day from Friday. So NASDAQ didn't even take out Friday's lows and still holding the rotation zone. So there's not been major technical damage done just yet. It looks scarier than it is. That does not mean I'm not prepared. That does not mean we don't prepare. And if you have a fantastic signal besides, hey, on every big or red day you say, let's go short, which is not a very good signal in my book. So, Dow. Now, the Dow could get interesting. We don't have the key first level technical close. The Dow's a little messier. The main technical closing area is about 33,550. The minor technical closing area is about 33,870. Let me get this closed, about 33,871. What could be interesting, and this is a little premature, but if we get a little rally back over the next couple days, we could get a head and shoulders top in the Dow. It's one thing I am watching for. Little lower probability with this flat area, but that could be the topping sign for the Dow. This is not a double top. By the way, these tops are separated by too much. So if you don't break that low, you can't use those targets. I'd be watching the breakdown from this area. Russell. Now, Russell is closing in a lot quicker. The Russell's closing in a lot quicker. The low close is from the 28th of November, 1832.80. And right below that's the 50. And right below that triggers the double top. So the double top, and it's a little icky because of this big move up there. But I will watch it for the key pullbacks, especially because the second target's right in front of the 62. This is not the highest in this scope of things. This is not the best double, but I will watch it because of the NASDAQ double. Hey, Jake, happy to see your channel continue to grow. Well, thank you very much, Jake, and thank you for being here. Shopping at a steal your face tees and hoodies location. That's right. Steal your face. Exactly. I have to pretty much order that stuff. Everyone who bought the dip on Friday is already under. That dip was secondary on Friday. I know what you're talking about, but that dip happened so quickly. The more important thing, the Friday dip, yeah, it got these people, but that was more aggressive, shorter term, really traders that might not have held a lot of the over the weekend. The longer term signals were a little farther back, so those are the ones that are more important. And where is this thing going to close? Where is it going to close? Right now, we're at 406. Mike Prophecy says S&P cap gas fill at 38.61 must come to pass. It will come to pass. Well, nothing's 100% guarantee. But for the cash S&P, which this gap will get filled, but it doesn't have to get filled in December. We get the bigger breakdown. Yes, I will be targeting that. And the full gap fills down to this key close, by the way, not to the open. So that could be a return to the 37.50 area. But again, we have not done the technical damage. This could also get filled in January. I believe it will be filled. Oh boy, thank you. In the 12th month of the 22nd year, thou shalt fill thine gap. Well, there you got, okay, Nostradamus. No, we're not going to just call you Georgie Porgy. We got to call you Nostradamus Georgie. All right, we got that. Can we see the spiders? We can see the spiders. If I can get up my harmonics correctly. So there are your spiders. Again, holding the rotation zone just like the S&P. So in the spiders, tomorrow you should be watching 397.59. But the start, the real technical low close on the spiders is back from the 17th of November. That's why the futures are so much more important. That's why the futures are more important. But your bottom of your rotation zone essentially would wipe out J-Pow Wednesday. In other news, the notes, inside data Friday, nice little pullback. Not targeting the gap just yet. That's going to get interesting over the next couple days. So, but that would just be into the rotation zone. So that's if we start breaking both Friday's lows, that's a quick little play I'm watching to the J-Pow Wednesday's close for a gap fill into the rotation zone. But again, from a notes perspective, standard pullback so far. Not even tapping the daily rotation zone. Dollar index. Do we have a significant bottom yet? I said I was watching for a reversal, but we don't have a significant bottom inside day to Friday. Not even back to the breakdown area or the rotation zone just yet. So tomorrow is going to be interesting. You start getting back above about 105.40 at this point. It could be a quick trip to test the high areas from the end of November and the other end of the rotation zone. And that would do much more technical damage potentially for a pullback. Remember, the pullback in the dollars also bolstered the equities. So keep that in mind. VIX up, but not. There's not a lot of fear today. Yes, up, but just back to the rotation zone and back to the long-term trend line breakdown area and above the Wednesday, November breakdown area. But we really need to get some much more technical damage done or a longer-term bottoming pattern to put in before. And as I said before, next, not this Friday, but the following Friday is a massive quarterly OPEX. Crude. Remember, never triggering that double top. Coming back down, breaking down, and then just running to the second target. So crude, pretty much with this we didn't close below the 62.5 of this area, but I'm pulling this off. There's no point. We could leave it up there technically for a bit longer, but overnight, if you come down here and smack that 75, it's pretty much done, and it never triggered. So the rotation zone holding on the daily basis without that double bottom getting triggered. And closing, I was watching for the close below the 62.5, did not happen because then that was the probability shifted to retest this zone. So it's sort of in no man's land with another target down below being 76. Gold pulling back. This did not surprise me. Gold pulling back outside bar from Friday. I'm targeting the gap fill. Targeting the gap fill. Cycles now rolling over on the daily, remember, and at the top on the weekly. I've talked about gold. Watching for that pullback. We're now starting to get that pullback. Euro, not any major technical damage done. I'm watching to see how it's going to hold that daily rotation zone. And Friday didn't even come back to Friday's low. So 104.30 area. Pound didn't even break Friday's low. Didn't even get back to rotation zone. The level I'm watching on the pound is about 121.20. Bitcoin still did not get a close above the end of November. So no breakout play just yet. So little reversal with the markets with daily cycles rolling back over. So see how interesting to see how much damage comes in there. Tesla, excuse me. Wow. Tesla closing at the 50%. Excuse me again. 50% from this pullback. The technical damage area starts on the close below 178.46. But so far, just a technical pullback. So not much else to talk about there. Let's see. How do you handle trading after taking a big loss? Well, what do you mean big? No loss should be bigger than any other loss. Else you're not managing risk correctly. Okay, that's first off. So if you're taking outsized losses, now there's always things where you can get oversized losses than expected due to gaps, due to stop slippage, but that more so happens with gaps. So if it was due to a gap, that's one thing, and you just, hey, if stuff happens. If it's due to you not managing risk correctly or putting on oversized risk positions, that's key. That's something you have to look at that. And that's more correcting that behavior. So you're not in that position. Otherwise, taking a larger, let's say, due to a gap, I like to do stops on closes. And yes, you can get market moves that cause bigger normal losses. Just part of trading. You can also get stuff that give you bigger normal gains, i.e. I have a target and it gaps way beyond my target. I've had that happen many times too. I'm long something. I have a target. Let's just use Tesla. And this is not anything that's I'm projecting or anything else. But let's theoretically say, hey, I'm long Tesla from this head and shoulders, inverse head and shoulders, which was horribly sloppy. And then Tesla releases something overnight and gaps up. Let's say my target was 212.50 and Tesla gapped up to 235. Hey, well, that would be an outsized win, but it's nothing I did. If I have my order there, or even if I don't have it there and I have an alert go off and I'm connected at 235, I'm taking the oversized win. But I'm not going to pat myself on the back for an oversized win. Just like if I'm long here and says my stops 178.47, 178.46 on a closing basis, and my walk away is 174.37, which means if it trades intraday below that, and Tesla, horrible news comes out and Tesla gaps down to 160. I'm out. Is it an oversized loss? Yes. But it's not a crippling loss because I have managed my position. So let's say I had 2% risk and that takes the loss to 3%. Not going to destroy my portfolio. It's an extra 1% loss. I go, that's part of trading. It sucks? Yeah. But if I said, oh, this is a guaranteed winner in Tesla, I'm putting, instead of 2% risk, I'm putting on 20% risk. And then it just comes down and hits my stop level. That's on me. And then I got to look at my whole trading plan, my whole portfolio management and say, what am I doing? Does that make sense to everybody? Sorry to go down sort of a rabbit hole, but I think this is important. That's why we position size here at Path Trading. Because I've talked about this many times before. Let's just take a double bottom pattern. And it doesn't matter, you have probabilities associated with each kind of setups and entries. But how do I know which one's going to work? I don't. There are ones that I thought would never work, yet they worked great. There are ones I thought this was a slam dunk. Stop out. So I don't know. If I did know, I would not get in the losers ahead of time. Think about it. It'd be part of the system. So how can I oversize one position versus another? Let's say I have 10 doubles in stocks and I can trade 10 stock positions at once. All right. I don't sit and take 10% risk on one double and 2% risk on another double, even if I like one better. Why? I don't know which one's going to work. So let's say the one that I put 2% risk on, and let's just call it 1-to-1 reward to risk. No, we're going to do better than 1-to-1, but I'm just using an example. Let's say my 2% risk is $2,000 per trade. So I'm going to put on $2,000 on one trade and a 10% risk on another trade of $10,000. And they both have the same probabilities. Well, this is me then would be being an idiot because let's say the 2001 was one of the ones that hit the probabilities. Oh, great, I made my $2,000, and then the 10,001 is the one that didn't because I upped my risk on a same probability trade. Well, now I'm 50-50 based off those two trades, but I'm 8 grand underwater. I could hit a bunch more trades and an outsized risk could eliminate a lot of winners. That's why position sizing and risk management, it's not sexy, but it's key. I hope I didn't bore anybody here. Oh, that's horrible advice. I know you're kidding. You better be kidding, George. That's the worst advice. And by the way, I hope you are kidding because you don't take a losing position and go, I'm turning it into a long-term investment. In bad market conditions, you'll have a lot more long-term investments you don't want to be in. You take a friggin' loss. You close out the trade. And then if it was something that you did wrong, like outsizing risk, then you address that behavior. If it's just something that happened, it's part of it. Is that the current episode you're talking about, George? The Futures Edge one that dropped today? Is that? I hope you were referring to not the whiskey and drugs and holding into a long-term position, but what I was talking about, Connor. Great move on gold today. Also, nice heads up. Well, that's what I'm here. I'm not trying to give people specific trades, although I will call out things like that I'm spotting, but I'm trying to help people manage their own positions. Hey, Royal Palms. George likes his SBR. All right, so let me know if that little the little, I don't know if it was a rant, the little bit on risk management makes sense to people. It's what the downfall of a lot of traders are. Improper risk management and trying to figure out ahead of time for certain probability entries. And different entries and different setups will have different probabilities. And you can gauge your risk across different setup types. But you should not just be willy-nilly trying to figure out and taking outside risk on a specific position. You can take an increased reward to risk. Like there's something called that we call like flyers, meaning I can keep a very tight stop and have like 10 or 15 to 1 reward to risk. But I'm definitely not increasing my amount I'm going to lose on that. It's just because if they run, they can increase the amount I make on them. But I'm not taking on increased risk. Again, if you had a crystal ball to know which trade again would be a winner, you would never get in a losing trade. Last time I checked, that crystal ball does not exist. Thank you, Coco. Thank you for being here also. How do I stay in trade and lock in a profit? Sometimes I can't stay in a trade long enough and I paper hand it. I know my levels beforehand. And not just levels, I know how I'm going to exit the trade beforehand. Whether it hits a target or whether it's a trailing stop method or whether it's a combination of both. I know those before I get in it. Therefore, I've fully mapped out the trade. For example, let's just keep the chart that's up here. Let's say this. All right, stop reduction, first target hit. Next target, take partial profit and raise stop. Final unwind. Now that would be an example. Another one could be that doesn't have a bunch of targets. They're target areas. For example, let's just say this was not a final target. Or let's see here, I'll use this. For example, let's say we have the Dow still potentially running to 35,807. To all-time high area. Let's just use this as an example. That's a target area. I know at a minimum 35,807 is a stop raise for a key trailing stop. So when it enters a target area, I'm going to be trailing a stop. Again, not advice on any trade. That way you don't get shaken out bar to bar. Too many people, they live like this. They get in. All right. Yeah, okay, this turns boring for them. So they're like, this is not doing anything. Let me get my money back. It's not moving. I got long. It's not moving. I'm out. Or they like bops up. Let's just say it was entered on this close. Oh, great. I can break even. The trade wasn't going anywhere. I'm done. And then it goes. Or, okay. Here's my first target. I got my target, 34,700. All right, we're going there. Big red day, big red day, big red day. Get out. And then target. They live bar to bar. Now, if you were trailing and this broke a key stop level, yes, that would be a viable exit. Hey, it broke my stop level. I'm out. But if your stop level's still down here and you exit prematurely because you big red bar, then you're not following a plan, or you don't have a plan for that trade. So why back when I started off today's live stream, people go, big red bar, S&P big red bar going new lows. No big red bar going new lows. This didn't even do significant technical damage. Could we get to new lows? Yes. But you don't go, big red bar, I'm out. Unless you have a something you're following that you've tested out that gives you, now some people might. There might be a system out there, somebody says that this signals that we should go back to 3,800. Fine. If that's a system you're following and you have your probabilities, you have your reward to risk, this could be an entry for you. But then you'll have an associated stop and an associated target. Just to saying, I'm going short because big red bar, that's not. Just like going long because big green bar is not a strategy either. Unless you have a specific entry strategy tied to it. Because if you have a strategy, then you can manage to trade according to that strategy instead of living bar to bar. I call it, and I've done stuff on this with candlestick math. People do live bar to bar. I'm long green bar. Yes. I'm long red bar. No, I'm out. And then big green bar. Oh, I'm out. I was out. I didn't know. Oh, man. You can't live bar to bar. That's why you got to define stuff and you got to know your methodology. At least if you know your methodology, you'll then know, hey, I violated my methodology. Then you got to take steps to figure out how to not violate your methodology. But if you don't have a methodology, I can't help you other than that's why I try to show things consistently. Occasionally I'll introduce a new concept on this channel, but you don't see me one day promoting Elliott Wave, one day promoting DeMark, one day promoting cycles, one day promoting MACD, one day RSI. Well, let's see what's going to work today. You know my tools I put up every day because I'm trying to show consistency to everybody. Do I put up everything I do? No, because we'd have to be 5-hour live streams. And I've been doing this for over 30 years. But I show consistency so people can incorporate some of these things into their trading strategies. Risk management advice is always needed. I struggle sometimes even with a one lot. Risk management is what will make or break a trader. Everybody thinks it's some magical entry system. Entry systems can help. Exit systems are even more important. Getting in is easy. Getting out is harder. Exits are even more important. But even more important than entries and exits, risk management. You can take 70% entries, and if you have crappy risk management, you can lose money. You're right 70% of the time and you're losing money, that's on you. We'll see. Makes sense. It's just hard to stick to the plan at times, especially when you feel overconfident. I guess with my trading, I don't feel overconfident or underconfident. It's just probabilities. And you got to accept probabilities. But I mean, knowing that there's going to be losses, I guess that's not an issue that would be my challenge, is feeling overconfident. It's also why I don't vary my bet size for like on a trade by trade basis, because I'm not smart enough to know which is going to work ahead of time. I will keep saying that. If I came up with something to, like, I will discover new things and add them into, maybe I'll even discover something that'll bump up the percentage 2 or 3 or 4 points on a system. Great, that'll get incorporated into the system on a long-term basis. But that doesn't mean that my bet size, I know which next trade's going to win. The most recent futures edge. Well, I'm glad you enjoyed it. I'm glad you were kidding too. Everybody should watch the futures edge, especially the ones starring me. For me, it's entries. I take pennies and miss the pounds, trying to capture smaller moves leading up to big ones. Well, you also challenge you to look at, are you trying to, that's why I love the advocate of multiple lots in futures, and you can do that easy with the micros. Or, again, in shares, you can put on multiples, because I love to get to unwind some position, raise my stop, lock something in, leave something to run. That's one of the best strategies I found to incorporate for people who are constantly bailing out too early. Find a level that makes sense to raise your stop where you can unwind part of the position, and then leave part of it on to run to a higher target area, but also identify that target area or zone ahead of time. And then learn to sit on your hands. You're welcome, Dr. M. I don't go to bars anymore. Well, there you go. So you don't have a problem with drinking when your stops are hit. You do have to be patient as a trader. Thank you, Mike. I've gone from negative 20% to March to negative 2% today, a gain of 18%, learning how to figure out targets and be patient enough to execute them. And that's fantastic. You've dug yourself by doing better analysis and trading, dug yourself out of a hole. Now apply that long term consistently, and you'll turn that around to positive numbers. Fear and greed are your enemy. Greed's definitely an enemy, but so is fear. You can't trade. It's hard. But trading from any major emotional standpoint clouds a trader's judgment. That's why one of the best things you could do before you even enter the trade, even enter the order, have your analysis done. Too many people get in a trade and then they don't know where their stop's going. They don't know where their targets are. And then they're living literally candle by candle. And they're an emotional wreck because they didn't plan out the trade ahead of time. You're better to plan the trade ahead of time and then execute it, because then you have your plan. After following this channel for many months, the only downside is trading is now pretty boring. Just waiting for patterns and being patient. Well, that's part of trading. If it's boring, you're starting to do it right, Daniel. Look, if you need juice, I call it the juice. You know, if you need the juice, get it elsewhere. Don't get it in trading. Find your excitement elsewhere. Boring trades are good trades. Boring markets are good markets. Boring portfolios are good portfolios. Get your excitement elsewhere. Go to an amusement park. Do something. But don't get it from trading. Using small margin for now on 5% or less leverage, no higher than 10%, so I can leave some longer positions open versus looking at the bars. Yes. And since Stafford stopped going to the bars, he doesn't have that problem of living bar to bar. Do you have an idea of when you'll release your trading course? I am re-recording a bunch of stuff now. I switched to a new hosting platform. So I'm going to start dribbling it out. That didn't sound right. I'm going to start releasing it slowly. But if you've been a member of this channel, I share a lot of stuff here. I truly try to help, and it gets me to become a better teacher. Interacting with everyone here on a daily basis and answering questions real time. Helps me become and refine the art of teaching. So I appreciate that. All right. I don't think there's anything else we need to look at. I just wanted to double check something. See, even, you saw, if I call back up this, I'll just give you an example. Where am I? Then we'll call it a day. Like you see, Apple's only down 80 basis points. Microsoft down 189 basis points. What? I was wrong. I better get out. Look at this. Take a look at just the chart pattern. Yeah, it was down. It was down, especially from Friday's close. But did it do let me just mark off some key levels. And I'm not saying Microsoft can't go lower. What I'm saying, though, is instead of reacting to looking at a number saying, oh, no, let's say you bought anywhere in here. And then your targets are up here. Even you're targeting the 200 on the daily. And you go, oh, wait, I looked at my heat map. Microsoft down 189 basis points. What? But look what it did. Pulled back. You got support. You still closed above Friday's open. You're holding the rotation zone. Even below this, if you're in it for a longer term trade, you still got the bottom of the rotation zone in the 50. Now you start getting down here. Would I want to be in any longs for Microsoft? No. But if I'm bailing on a Microsoft position from the long side because of today, this did not do major technical damage just yet. Even if it pulls it back a bit lower, it's not major technical damage just yet if you're in for a longer term trade. So, I already looked at Bitcoin, John. Bitcoin, nothing still. It was attempting to break out with today's sell-off. But as I said, if you ever try to front-run a breakout pattern and it doesn't close above the key level, which is on this chart, 17,165, I personally can't hold it then because it did not confirm the breakout. So we still have the breakout level above 17,165. The breakdown level, the conservative breakdown level is about 16,811. You break down from there, I watch for 16,442 to 16,2 16,200, and then a close below that 62.5 would be a retest of the lows. So that's it. Also remember on Bitcoin from the higher time frame, because people lose track of this. Went through this the other day. Rotate. You're against the weekly rotation zone. So we still favor downside. This is just a correction back to the weekly rotation zone. Even on a higher trade into the rotation zone, it still favors a rotation back down. Just like we've seen for a while. Rotation, rotation, rotation. So why trading against a higher time frame rotation zone is very hard. All right, then just a US dollar, Japanese yen. Looks like it might have turned bullish. I don't have a key bottoming pattern here. It still has to put in either a key bottoming pattern or start getting back above about 139, and then we get a pullback potential trade, and then we'll start looking more bullish. Yes, we could. There's no fantastic signal just yet, from my perspective. Besides, there was a aggressive. Why is it aggressive? Percent B buy signal triggered on the breakout, then followed through at the close. Why is it aggressive? Because it could roll over in the daily rotation zone, which is just overhead. So from a reward to risk perspective, unless you're trying to micro trade it or very short-term swing trade it, it's an aggressive trade. But that's the only thing I have counter trend against the 200. This was an aggressive signal, but it's only valid back into the rotation zone area. So this kind of aggressive reversal signal does not say, hey, we're going back to 150. No, it says we're going back potentially to about 137.30 to maybe 139.25. I took a loss on copper. I went over copper with on the Futures Edge podcast. Nothing's changed from a technical perspective. This is just pullback. I said to watch. Also on Sundays, I said to watch for metals and precious metals to both pull back. Depending on your time frame, I don't know your time frame. This is still in longer term buy. This completed a double bottom pattern. For the rest of the thoughts, I'll let you tune into Futures Edge. If this was just a day trade, that's fine. I mean, it was just a reversal. But in the longer term perspective, nothing's changed. And I go over the key levels I'm watching with Jim. Okay? With that, I'm going to wrap it up and call it a day. Thank you. I really appreciate everybody tuning in. Wonderful questions tonight. Could you come back and leave some comments if you enjoyed this session to try to help other people decide if they want to watch this episode? I think this is beneficial. And if you are new here, especially one of the people hiding in the background, please give us the benefit of the doubt and subscribe to the channel, and so you get reminded of the live streams so you can check us out. We are one of those, I call the fewer people that are truly designed to help people. You don't see us pumping stuff on this channel. You don't see us sponsored by a lot. We turn down a ton of sponsorships because I'm not going to pump crap out to people. And a lot of stuff out there is utter crap. There are some good people out there, and follow them too and subscribe to their channels too if they are reliable and good. Beware, though, there are a lot of wolves in sheep's clothing. You're welcome, Josh. The Santa rally doesn't have to be all of December. Why does everybody think the whole month has to be a Santa rally? It doesn't. Thanks, Dave. Thank you, Charles. All right. With that, I shall talk to everyone later. Have a wonderful evening. Thank you to all the new people tuning in. I will see you tomorrow morning at the regularly scheduled time. Bye for